Homeowners are losing tens of thousands of dollars. Bidding wars have vanished, and in some cities, prices have crashed by over 25% in just a year. Imagine buying a home for $800,000, only to see its value drop by over $200,000. From tech hubs to tourist favorites, once booming markets are now flooded with listings, price cuts, and desperate sellers. Mortgage rates near 7% are squeezing buyers out, while inventory is skyrocketing by as much as 56% in some regions. What's really going on, and what's next? In this video, we're diving into 10 major U.S. cities where the housing market is taking a serious tumble in 2025. Number 10. Fort Worth, Texas. Fort Worth, Texas. A city that was once a rising star in the Lone Star State's real estate boom. But now, it's quietly slipping. In 2025, Fort Worth's housing market is showing clear signs of softening, with home prices dropping by 7.3% year over year. It may not sound earth-shattering at first glance, but in a city where the median home price once peaked near $350,000, that's a drop of about $25,550. That's no pocket change. So what's causing this mellow meltdown? A mix of overbuilding, stretched buyer budgets, and, believe it or not, migration fatigue. Fort Worth became a magnet during the pandemic housing frenzy, with Californians and New Yorkers pouring in, pushing prices up nearly 40% between 2020 and 2022. But now the flow is slowing, and inventory is rising, up 29% year over year, giving buyers more options and sellers fewer bidding wars. Mortgage rates above 6.8% have added insult to injury. That once affordable $1,800 monthly mortgage on a typical home now looks more like $2,400, pricing many locals out of the market. Plus, as remote work policies tighten, some buyers who moved here during the work-from-home craze are packing up and heading back, or simply not buying at all. If we talk Fort Worth's job market, while steady, isn't immune to the national slowdown. Construction, tech, and even logistics, sectors that helped fuel growth, are slowing, making buyers more cautious. Combine that with inflation eating into household budgets, and you've got a real estate market that's, well, cooling faster than a Texas sweet tea left outside in January. It's not a crash, but Fort Worth's downturn is a classic sign of a once scorching market returning to earth. If you're house hunting, it could mean deals. But if you bought at the peak? Number 9. Portland, Oregon. Portland. The city of coffee shops, bicycles, and quirky vibes. But under the charm of this Pacific Northwest favorite, the housing market is going through a not-so-hip downturn. In 2025, home prices in Portland have dropped 8.3%, and that's after years of explosive growth that pushed the average home to over $550,000. So what's the damage now? That's about $45,650 wiped off a typical home's value in just 1 year. So, what's behind the drop? For starters, Portland has seen a surge in listings. Inventory is up 36% year over year, flooding the market with choices. Back in 2021, homes were flying off the market in under a week. But now, sellers are waiting an average of 42 days to get a bite. That's a big shift in buyer demand. Rising mortgage rates near 7% haven't helped either. A buyer who once locked in a $2,200 payment now faces closer to $2,800 for the same home. And let's not ignore the elephant in the room. Portland's population growth has slowed significantly. After years of people moving in from California and Washington, the trend is now reversing. More people are moving out than moving in, with net migration dropping by over 12% in the last year. And honestly, affordability has become a serious issue. Portland used to be the cheaper Seattle, but not anymore. It now ranks among the top 15 most expensive mid-sized cities in the U.S., which has priced out many first-time buyers and young families. Combine that with rising property taxes and a cooling job market in the tech and healthcare sectors, and you've got a recipe for softening prices. For buyers, this could be the window of opportunity they've been waiting for. But for sellers, Portland's housing hangover is starting to sting. Number 8. Phoenix, Arizona. Phoenix, Arizona, once one of the hottest markets in America, just got a little too hot to handle. In 2025, home prices here are down 8.5%, and that's a pretty steep slide considering Phoenix saw nearly 60% growth from 2020 to 2022. Homes that were selling for $475,000 at the peak are now hovering around $435,000, meaning some homeowners are watching $40,000 evaporate. So, what caused this desert flameout? It's classic overheat economics. During the pandemic, Phoenix became a magnet for remote workers and out-of-state investors. But once interest rates spiked, 6.9% average mortgage rates, the demand dried up faster than an Arizona creek in August. Monthly mortgage payments jumped by hundreds of dollars, putting homes out of reach for many local buyers. Inventory has also surged, up 43% year over year, and homes are sitting on the market longer. Bidding wars? Practically extinct. Even iBuyers like Opendoor and Zillow, who once scooped up properties like candy, have scaled back or completely exited the Phoenix market, leaving behind a trail of price cuts. And here's another factor. Phoenix's water crisis and scorching summer heat are no longer background noise. They're affecting where people choose to live. With multiple days over 110 degrees Fahrenheit, utility bills are surging and lifestyle comfort is taking a hit, pushing some would-be buyers toward cooler and more sustainable regions. Job growth is also flattening. While Phoenix remains a logistics and tech hub, hiring freezes and cost of living concerns are keeping people cautious. The result? Slower buyer activity and fewer investors. All this combined has Phoenix pulling a sharp U-turn from boomtown to cooldown. It's not a total crash, but if you bought at the top, you're definitely feeling the heat now. Number 7. Denver, Colorado. Denver's housing market isn't just cooling off, it's slipping on the ice. Once considered one of the fastest-growing cities in the Rockies, home prices in Denver are down 9.0% in 2025, which is a major wake-up call for a market that once felt unstoppable. With average home values peaking around $625,000, that's a loss of over $56,000 in just a year. How did we get here? First, the city got too expensive, too fast. Between 2012 and 2022, Denver home prices skyrocketed by over 130%. The pandemic poured fuel on that fire as remote workers flooded into the city. But now, many of those newcomers are second-guessing their decision. Interest rates near 7% have pushed monthly mortgage payments on an average Denver home from around $2,800 to over $3,500, squeezing buyers right out of the market. Then there's inventory. It's up 41% year over year. More homes are listed, but fewer are selling, which is pushing sellers to slash prices just to compete. Meanwhile, rental prices have flattened, making renting more attractive than buying for many. That's a big shift in consumer behavior. Job growth has also slowed, especially in the tech and startup space. Denver saw more than 3,500 layoffs in tech alone over the past 12 months. Combine that with inflation hitting gas, groceries, and everything in between, and many would-be buyers are pressing pause. Even lifestyle factors are changing the market. More locals are moving to outer suburbs like Parker and Thornton in search of better deals. The dream of owning a home in central Denver is fading fast for younger buyers and middle-class families. So yeah, the mile-high city is taking a mile-high plunge in prices. And for those who bought at the top? Let's just say it's a bumpy ride down from here. Number 6. San Antonio, Texas. San Antonio has always been known as Texas's affordable big city, but now it's joining the housing market crash club. In 2025, home prices have dropped by 9.8%, marking a sharp shift in what was once one of the most stable markets in the state. A house that was selling for $320,000 just last year is now closer to $288,000, wiping out around $31,000 in value. So what's going on? San Antonio got caught in the crossfire of Texas's population explosion. For years, people priced out of Austin and Dallas came here for affordability. But that migration pressure pushed prices up by over 50% between 2019 and 2022. And now the bubble is finally deflating. The balance has flipped. Inventory is up 39% compared to last year, and sellers are struggling to get offers. And affordability? It's not what it used to be. Mortgage rates close to 6.9% have turned monthly payments from manageable to intimidating. A buyer who could afford a $1,900 payment in 2021 now faces nearly $2,600 for the same home. That's a deal breaker for many first-time buyers. The job market here is solid, but not booming. Growth in military and healthcare is steady, but not enough to offset the slowdown in tech and construction hiring. Plus, rental demand is up, and more residents are deciding to rent longer rather than jump into homeownership. Another factor? Out-of-state investor interest has cooled big time. Companies that once snatched up starter homes to turn into rentals are scaling back, leaving more properties on the market and fewer bidding wars. That means more negotiating power for buyers and lower prices for everyone. San Antonio isn't falling apart, but the days of guaranteed appreciation and lightning-fast sales are over. For buyers, this could be a golden moment. But if you bought at the top, you're probably doing the math and not liking the answer. Number 5. Washington, D.C. Washington, D.C., home of the Capitol, the White House, and now, one of the steepest housing price drops in the country. Yep, in 2025, the nation's capital saw home values drop by 10.2%. And that's a serious dent in a city where the median home price was sitting around $620,000. That's more than $63,000 wiped off a home's value in just a year. So, what's shaking up DC's market? First off, the city has long had a complicated relationship with housing affordability. During the boom years, prices soared as government contracting, legal, and tech industries brought in high-salaried professionals. But that price climb left behind many middle-income families, and now that interest rates are hovering around 7%, the monthly mortgage on an average home has surged to nearly $4,200, putting the brakes on new buyers. At the same time, there's been a noticeable slowdown in government spending and hiring, especially in the defense and policy sectors. Combine that with remote work, which has pushed people to move to cheaper suburbs like Fairfax or Silver Spring, and you've got fewer buyers competing in the DC market. The result? Inventory has climbed 32% year over year, and bidding wars have become a rare sight. Another fun fact? Condos, once red-hot in areas like Logan Circle and Capitol Hill, are taking a beating. Many are sitting unsold for months, and price cuts of $50,000 or more are becoming common. Even high-end homes in Georgetown and DuPont Circle aren't immune to markdowns. Bottom line, the nation's capital isn't collapsing, but it is correcting. If you bought in 2021 at peak prices, you're likely underwater now. But if you're a buyer today, DC might finally be within reach. Just don't expect those marble-columned row houses to come cheap anytime soon. Number 4. San Francisco, California. San Francisco, once the king of American housing prices, is now tumbling fast. In 2025, home prices in SF have dropped a whopping 15.2%, and that's brutal in a market where the average home still costs over $1.1 million. That's a loss of nearly $167,000 in just 12 months. This isn't just a dip, it's a reckoning. San Francisco was the poster child for pandemic-era price surges, as tech stock wealth, venture capital, and remote work sent prices soaring. But now, the city's facing a trifecta of pain: tech layoffs, affordability collapse, and lifestyle shift. In the past year alone, companies like Meta, Salesforce, and Google have cut more than 20,000 Bay Area jobs, slashing the number of high-earning buyers. Add to that mortgage rates still around 7%, and even well-paid professionals are hesitating. A 30-year mortgage on a $1.1 million home at today's rate costs over $7,000 a month, before taxes and maintenance. No wonder listings are piling up. Inventory is up more than 46%, and price cuts are happening on over 36% of all active listings. Then there's the urban exodus. The remote work revolution made it possible to earn Silicon Valley salaries from places like Austin or Boise. Many workers left for good. Meanwhile, crime concerns and a sluggish recovery in downtown San Francisco have made the city less appealing to newcomers. Even investors are backing off. San Francisco's rental yields are among the lowest in the nation, and vacancy rates in downtown high-rises are climbing. Some landlords are offering 3 months free rent just to fill units. San Francisco isn't just cooling, it's deflating. For buyers with cash and courage, there are deals out there. But for those who bought at the peak, this golden city is starting to look a little tarnished. Number 3. New Orleans, Louisiana. New Orleans, famous for jazz, jambalaya, and now, a jarring housing market crash. In 2025, the Big Easy saw one of the largest price plunges in the country, with home values down 16.7% year over year. That's not a dip, it's a dramatic descent. A home that sold for $350,000 last year is now worth around $291,550, slicing off over $58,000 in value. So, how did this soulful city hit a sour note? A big part of the story is tied to natural disaster risk and insurance chaos. After multiple hurricane seasons and flood events, home insurance premiums in New Orleans have doubled in many neighborhoods, and some insurers have even pulled out of the state entirely. With fewer options and higher costs, buyers are backing away. But that's just the beginning. New Orleans has also struggled with economic instability. Tourism still hasn't bounced back to pre-2020 levels, and many hospitality workers who left during the pandemic haven't returned. The job market is stagnant, especially in downtown and French Quarter districts that were once buzzing with Airbnb activity. That same Airbnb surge is now biting back. Regulations have tightened, occupancy rates have dropped, and many investor-owned homes are being dumped back onto the market. As a result, inventory in NOLA is up 44%, and sellers are slashing prices fast. Some historic homes in neighborhoods like Mid-City and Bywater have sat for months despite multiple price drops. And let's talk buyers. Many locals are priced out, and out-of-state demand has cooled dramatically. Even cash buyers from Texas and Florida aren't as eager anymore thanks to rising crime rates, aging infrastructure, and those ever-spiking insurance bills. It's a tough cocktail: soaring costs, shrinking demand, and rising risk. New Orleans may still be culturally rich, but in 2025, its housing market is seriously underwater, literally and financially. Number 2. Austin, Texas. Austin, the Silicon Hills darling that couldn't stop winning during the pandemic, is now facing a brutal reversal. In 2025, home prices in Austin have fallen by a jaw-dropping 21.5%. Just think, that sleek $600,000 bungalow from 2022 is now worth about $471,000. A whopping $129,000 evaporated in under 2 years. So what went wrong in the capital of cool? Well, it's a classic story of overhype meeting harsh reality. During the pandemic, Austin was crowned one of the hottest markets in America. Everyone wanted in: tech workers from California, investors, remote workers, even crypto millionaires. Prices shot up over 70% between 2019 and 2022, making Austin feel unstoppable. But that speed came with consequences. Fast forward to now, mortgage rates above 6.8% have drastically shrunk buyer power. A home that once came with a $2,500 per month payment now costs well over $3,300 per month. Combine that with inflation and student debt pressures, and many millennials and Gen Z buyers have backed away. But that's not all. The tech sector, Austin's biggest driver, has cooled big time. Companies like Tesla, Meta, and Amazon have slowed hiring or laid off staff. Office towers that were once bursting with startups are now struggling to stay full. The result? Buyer demand has dropped, and inventory has ballooned by 52%, creating a highly competitive buyer's market. Also, a ton of new construction came online too fast. Builders raced to meet demand, but now many homes sit empty or unfinished. Some suburbs, like Pflugerville and Kyle, have entire neighborhoods with double-digit price cuts just to move inventory. Investors are exiting too. Short-term rental income is down, Airbnb restrictions are up, and more properties are flooding the market. Meanwhile, locals, who were already feeling priced out, can't afford the inflated prices, even after the correction. Austin is still vibrant, creative, and full of energy, but its housing market got way too far ahead of itself. Now, it's snapping back to reality with a loud and painful thud. Number 1. Oakland, California. Oakland, beautiful views, rich history, and now the sharpest housing market drop in America. In 2025, home prices here have plunged 25.5%, turning heads across the country. That means a home that was worth $800,000 at the peak is now closer to $596,000, a massive $204,000 loss in value. That's like losing a brand new Porsche without ever leaving your driveway. So why is Oakland leading the fall? It's a perfect storm. First, affordability was already tight. Oakland had long played second fiddle to San Francisco, attracting buyers priced out of the city. But when Bay Area tech layoffs topped 30,000 in 2024 alone, that buyer demand dried up. People weren't just losing jobs, they were leaving California. Second, crime and quality of life concerns have surged in certain neighborhoods, pushing even longtime residents to relocate. And those who remain? Many are simply renting instead of buying, especially with mortgage rates hovering around 7%. A typical loan payment on a $600,000 mortgage now runs over $4,000 a month. Not exactly budget-friendly. Meanwhile, inventory has exploded, up 56% year over year, as desperate sellers try to cash out before prices fall further. Homes that would have sparked bidding wars in 2021 now sit for months. More than 40% of listings have price cuts, and it's common to see slashes of $75K to $100K in just a few weeks. Another factor? Investors are retreating. Oakland used to be a top pick for rental income and flips, but with high vacancy rates and eviction moratoriums, many are backing off or selling at a loss. And as buyers vanish, sellers are slashing, and the spiral continues. Oakland's housing market was once red hot, but it overheated, and fast. With the tech sector weakened, affordability out of reach, and confidence shaken, this Bay Area city is now ground zero for the 2025 crash. It's still got soul, but for homeowners, this year has been Heartbreak City.